Hey there, Trader Tim from eminimine.com doing a trade recap. Today's December 3rd, 2020. In this video, I want to talk about today one of the ES trades that I took, along with one of the setups that I chose not to take, or lack thereof, why I didn't take it. I wanted to talk about managing gaps on swing trades, and then, but first, let's start with on the daily chart here, we've got this negative 23% target above us, and we're not too far away. And that being the case, and the fact that we've broken above this, we'll call it a triple top, but this ceiling, I see no reason why we can't make it to the negative 23% target. We've got open space to the left. We are in a period where beginning of December, we tend to see the market go up. It's often coined the Santa Claus rally. But if you're ever unsure, if you're looking at a chart, especially a daily chart, and you're thinking, well, do I want to be long? Do I want to put on a long position? And sometimes you can get stuck in a long bias and think, you're looking at a setup and you just think it's got to go up. A good check for that is to turn the chart upside down. And if you're on toss, a really easy way to do that is to just come up here to these three dashes, click the take screenshot, and then save that to your computer, and then just pull up that chart and then flip it. So if you rotate it and then mirror it, now that same chart is flipped upside down. And if you look at the chart and you say, oh, well, that looks like in this direction, it actually looks like a short. Okay, now that validates the long. But if you're looking at the chart upside down and it still looks like a long, or you see a long setup once you've turned the chart upside down, now when you turn it back the way it was, chances are it's not a good long setup. So that's a really easy way to just kind of remove that bias that you might have. And we talk about trying to think about the opposite and think about trying to get into a position when others are not, or when it's not front and center. And flipping the chart upside down is just a good little trick to break that mental habit. And then after a while, you can start to visualize the chart upside down without necessarily having to flip it. So before we move to the ES, I just wanted to talk about this Aqua swing trade because we had a gap down the other day. So the long is from the 20th. Above the high of the 19th. That's the entry. And I took a little bit off when we broke the low of the 24th here, just by trailing my stop below each candle's low. I just took a third of the position off to lock in some profit. And then we had this big gap down yesterday. And when we do that, if we get a gap down, first of all, I don't leave my stop orders existing for the morning, so I wait to put them in until we actually open, and in part for this reason. Now, it doesn't happen as much as you might think, a gap against you like this, but if we go to the 15-minute chart, what I'll do is just once the 15-minute bar closes, then I'll put my stop underneath that candle's low. And so still in the trade, have 2/3 of the position left because I took profit on a third. It's really it's not that big of a deal as far as the gap down, and we'll see if we can kind of crawl our way back up. We're getting a little bit more of a channel here starting to form, and so there's still potential for us to come up and take out the swing high and put in new highs. We're still above the swing low, but rather than just panic at the open and sell out of the position, waiting that first 15 minutes, you're rewarded for having that patience. So that's how I manage gaps on swing trades. I know a lot of people like to turn to day trading to avoid holding positions overnight, but you can make a lot of money with holding positions even for just a couple of days. Whether you're just trading the underlying or, as we've been talking about lately, trading options on these bigger movers like Tesla, there is a lot of potential to make an exponential amount of reward for a very small amount of risk, that asymmetrical risk that we talked about last week. So let's shift over to the ES. The morning really started out pretty blah. The first hour, or the first half hour, we were just moving sideways inside yesterday's range, kind of near yesterday's close, without a real decisive trend. And so these two lines that I have here are simply the high and low of the first 30-minute range. So if we do this, we can see that first 30-minute candle, high and low. And it's just a good gauge to give us an idea of, are we likely to be range bound or are we likely to be trending? If we break out of that range right away after 30 minutes, we have a better chance to be trending. If we stay in the first 30-minute range, then we have by definition, better chance to be range bound because we are within a range. So today was a little bit odd how we sold off and came so far down but didn't come to the bottom of the 30-minute range. Like if we draw up the halfway back, which a lot of the pit traders will use, that was all the way up here at the top of the first 30-minute range. We came down and traded inside of the range again, but weren't able to go all the way to the bottom, and then we kind of made this V reversal and popped back up. But once we got this push on this bar at the top of the hour, I came over to the 512 tick chart, because what we had setting up is a long right on top of that 30-minute range's high. And so being that we are entering into open space, this was our high back here, and we were pretty close to approaching that high and breaking up into open space once again, meaning there's no resistance above us. Getting in along here seemed like a really good, a high probability setup, because we have support on top of the first 30-minute range. We even have support from the last 5 or 10 minutes of just moving sideways. And so that was the long entry. And then I just draw up the next retracement as a way to trail my stop. And then continuing that forward. I chose, it really didn't matter. I chose to start, I used the anchor point here, and then I just brought it up to here. And that's where I got taken out. If you trailed your stop under the first one, and then redrew it from that anchor to highs, it brings your stop up an extra tick, but it really doesn't matter. Once you're in the trade like that, a tick or two is not that big of a deal. And then the trade that I didn't take, we came into new highs and then started making kind of these series of tops, basically a quadruple top up here. But this double top that we formed looked promising at first. The dip, the swing low in the middle was pretty far below. So in order to break this swing low to set up in a short was a ways away. But we did have a high tick at 33 that lined up with high price. But because we didn't break that swing low, there was no entry. And so rather than taking the short like this without a swing low break, the market would have needed to come down and take out that swing low in order for me to get in the trade there. So I did not take the short like this, even though it was a double top. And then we did not get we had a new high price at 42s, but our high tick occurred before that. So we don't have a high tick at highs. And now you can see us coming back down and right back to the top of that first 30-minute range. A bit of a triangle forming. We have a lot of day left here still, but we've got kind of like this, and if you ignore the wicks, you could draw something like that. If you wanted to make it a ascending triangle, you could draw something like that. So as long as we hold above the swing low, so here is the low of the day, then we put in a higher low, then another higher low, then another higher low, we still have potential to break out into new highs. But if we come down, and currently the most recent swing low is here, if we take that out, now that uptrend is violated and is no longer valid. So when you're looking to trade, like when you're swing trading and let's pretend this was a daily chart instead of a 5-minute chart, buying call options at the trendline support, you're going to pay a lot less for them than if you're buying them on the breakout. And so buying calls at support, or selling, or buying puts rather, at resistance is a really good way to get in at a cheaper price for that contract, as opposed to buying a breakout when the contract is more inflated in price. And you're seeing that a lot with the the Tesla options. If you go through the option chain, there's just buying them down here when nobody was really paying much attention. I bought them very, very cheap. Buying them up here, you're going to pay a lot more for kind of the corresponding reward. So if you have questions, feel free to shoot me an email, tim@eminimind.com, or leave your questions below if it's a general question. And Monday next week we'll be doing a masterclass all about E-mini futures trading. So I'll put a link for that in the description below. Thanks, and have a great week.